you. Thank you. We got the clicker here, right?
Yep.
Hi, everybody. My name is Dan. Thank you for that introduction. And I'm here to give you a perspective of how some investors are choosing to use alternative data as part of their investment process, specifically for me in the consumer and retail space. I've got just a few brief slides to present to all of you, and I'll leave some time for questions. I would really encourage you to have some questions, because your other alternative is to have me stare at you awkwardly for 10 minutes at the end. So please do that. And one other caveat is what I'm going to present are most certainly my opinions. They're not facts, so please take what I say with a grain of salt. Just a quick bio on me. I've got about 10 years of experience in retail and consumer, both consulting and investing. I spent 3 years at Oliver Wyman consulting in consumer retail. I spent 4 years in private equity, primarily looking at investments, long-term investments in consumer and retail. Then for the last 3 years, I've been the analyst in consumer and retail for a hedge fund called Atika Capital Management. While I was at Atika, I'd like to think I had a couple of high-level insights about the consumer and retail space, which led me to leave Atika and start my own small retail and consumer fund that's highly data-driven. And 1010, obviously, I'm here because they're one of my most important partners. In fact, I would say I may not have been able to start my fund without all their support and assistance. Moving on to what I think of as the first high-level insight, if I can call it that I had during my time at Atika. And that's, I came to Atika to effectively take what I was doing at Bain Capital and do it in a hedge fund model, which is to be your traditional long-term value investor in consumer and retail. And it may have turned out that maybe I wasn't smart enough to do it. Or the other interpretation might be that it's become really, really hard. And I think the reason for that is a lot of the barriers to entry that used to make it possible for people to predict what's going to happen in the space in the long run have really eroded and come under assault. Back when I was at Bain Capital, we would take a look at 3 primary things. I mean, we'd look at other things as well, but there were 3 primary things we'd always look at to try to predict long-term winners and losers in consumer retail. And those things were, as you see here, is real estate, scale, and brand. Those things still matter, but a lot less than they did. A lot of the people in the room here know that with e-commerce, real estate has become as much of a liability as it is an asset in many cases. Scale as well still matters, but less than it used to, because now it's so easy to start a new retailer or a new brand online only with very little capital up front, because not only can you go online only, but you can also outsource your entire supply chain, which means that all the purchasing scale and all the investment in building an organization is no longer really required like it used to be. And that's increasing new entrants into the space, and it's increasing rivalry. And finally, brand. Once again, of the 3, probably the one that still, I believe, matters the most to brands, but not like it used to. People are just less brand loyal now, and in fact, more and more there's this phenomenon of consumer promiscuity, where consumers are more and more willing to try new brands, and in fact, a lot of them start looking for new brands that are not mainstream because they think that's kind of cool. This phenomenon is happening across the entire retail consumer landscape, and I always use the example of beer. Back in the 70s and 60s, there was basically 7 brands of beer, and they accounted for like 95% of sales. And now, I mean, it's like 4,000 or 5,000, and even Sam Adams is now considered to be not very cool. So all those things combined, I'm sorry if there's Sam Adams representatives here. Actually, a blanket apology if I mention any retailer that's in the room, because I was not given a full roster of who's going to be here. Later I have an example of a trade, and I should have probably made it a long rather than a short, now that I'm standing here. Anyway, it's become challenging to predict long-term winners and losers. And the whole space has become more chaotic, right? Let's say you've got some retailer or some brand that's doing well today, right now. More often than not, it's for pretty transitory reasons. Maybe they really hit it out of the park on a particular fashion trend. Maybe they've got a hot new product that's doing really well. Maybe they've got some marketing campaign that's just really lucky, or not, I shouldn't say lucky, but but is really working. Like Express, when they got Steph Curry, and then he became this phenomenon, and they had him locked up for a year. The problem is those things are frequently pretty transitory, and frequently they don't tell you very much about whether the company will still be doing well a year from now, to say nothing of 5 years from now or 10 years from now. And the challenge that this presents to investors is that we now have to infer value of companies from, unfortunately, shorter and shorter term trends. And in some ways, we've kind of become dumber because the industry's become harder to predict. And more people are looking at very simple things. Your top line. Is it accelerating or is it decelerating? Your margins, are they shrinking or are they expanding? And finally, what's the word of mouth on your brand? Is it hot? There's no one from Michael Kors here, right? Yeah. Are you on your rocket ship up, or are you over-distributed and people don't think you're quite at school anymore, right? Once again, apologies. Anyway, the proof in the pudding there is that, believe it or not, you take a look at the last 10 years, and volatility in consumer retail around earnings events has actually increased. Everyone thinks that, oh, it must be going down because there's more data available, but in fact, the opposite is happening I believe, for this reason. So that's kind of like the first of the two, hopefully, insights. And then the second is, at least from my perspective, for me personally, more positive, which is, hey, these short-term trends are becoming more important to the valuation of companies, and at the same time, our ability to track these trends relatively inexpensively, though people would argue, at scale and accurately across a whole number of different sources, independent sources, is growing pretty much exponentially. And the reason for this is really obvious, I'm sure, to everyone in the room, right? Almost everything that we as consumers and some of you guys as brands and companies do, both online and in the physical world, is leaving digital footprints somewhere. Sometimes they're kind of disorganized and difficult to gain signal from, but that's what big data is really great for, taking a big mass of unstructured data and drawing signal from those things. And if you just take a look at what's going on in the physical world, we're all carrying around smartphones, which are a gold mine of information. Whether you're sort of scared about that for privacy reasons or not, it is happening. The number of sensors out in the physical world is growing exponentially, and our ability to process those things, the Internet of Things, is also making the physical world more trackable. Obviously, omnichannel is a huge trend and becoming more important every day. So the more that sales go online, the more trackable that is, because obviously it's digital. And then finally, in order to figure out why things are happening, it's useful to hear from the consumer in real time. And consumers in real time are just screaming at us with everything they like, everything they don't like, where they are, what they're doing, what they're eating, which fashion brands are resonating. And once again, that data is messy and unstructured, but big data is phenomenal at getting signal from the noise. So that's sort of the second sort of higher level insight, that these things, short-term trends are becoming more important and trackable. But here's the key. I think triangulation, for me, has been the most important part in being able to take these insights and to turn them into a business. And the reason for that is no data set, no matter how good it is ever perfect. And even, I'm sure our friends here at 1010 would tell you, their data is great at predicting lots of things, top line for lots of companies, but it's not always right. And people frequently get mad, and they get mad at data providers when their data ends up being wrong and they lose money. Well, duh. Take a look at the back tests. Like, you're not, you're going to be right 60% of the time, 70% of the time, but you shouldn't expect 100% fidelity. But if you have multiple sources tracking the same thing that are independent, let's say each one of them is only 60% accurate. On its own, that might not be that great, right? But let's say you have 3 of them, and they're fully independent from each other. All of a sudden, you're getting to a point where, gee, I'm going to be right like 85, 90% of the time plus. And that starts to be a pretty significant advantage when you're tracking things that really matter. And then finally, it's important to track more than just one thing. 1010 is phenomenal at tracking the top line of lots of things. That's only half the story. When it becomes really powerful is when you can triangulate and figure out what's happening with sales, what's happening with margins, and why it's happening. I'll give you an example of how we can do that in just a couple minutes. But before I give you an example, I just want to give you sort of a sampling of, this is by no means an exhaustive list. This is a list I sort of put together off the top of my head. And this isn't even all the sources that I personally use. But you can see there's multiple different sources available to track top line, to track, or at least directionally, what's happening with discounting, promotion, and margins. And there's a ton of social sources and blogs and review sites that make it possible to also frequently figure out why what's happening is actually happening. And so I won't tick through these one by one, but if you guys have any specific questions about them, I'm certainly happy to talk about them at the high level after I'm done, or even now if somebody can't wait. Yeah, I saw people taking photos of this. Feel free, though. I think this is, there's better lists than this available out there. I'd be happy to send you to. So, nothing brings, I think, things like this to life quite like an example. And an example I'll give you is a real life example of probably the most profitable trade that I was able to make so far this year. And really, once again, wish that I picked something that went up. But this is probably the best example that illustrates the power of triangulation across multiple sources, and it's limited brands. For those of you, I'm sure most of you know, but for those of you that don't, limited brands is a portfolio of different retailers, but by far their biggest asset is Victoria's Secret, mall-based women's clothing retailer. And I'm sorry that I'm going to be in a position of mansplaining women's fashion trends in that category, but here we are. So limited brands reports their results monthly and gives guidance monthly. December is their most important month. Obviously, it's a holiday period. And so they gave an update at the beginning of December, gave guidance for December. So they gave an update on November, beginning of December, and gave guidance for December. And so they gave their top line guidance, and they also said, hey, November was really promotional, but we think December is going to be less crazy promotional. And then what we do is we track all these different data sources, and we try to compare them to guidance, compare them to consensus, and try to spot inflections and dislocations. And lo and behold, 20 days into December, all of our warning sirens started going off for top line stuff. So we were tracking all the credit card stuff with 1010's aid and all the debit card stuff. I'm sure you guys are, your customers are familiar with how that works. And sales seem to be really falling off a cliff, almost to a degree that didn't seem entirely plausible. So I checked my other sources, and we were looking at panels of receipts, e-commerce receipts that are falling into people's email boxes, and those started falling off a cliff. We were looking at clickstream data, where we're tracking the number of people going to the e-commerce website, and crucially, how many times they're landing on a page associated with a checkout. And those started falling off a cliff. And what are some of the rest that we used? Oh, yeah, that's right. So it was actually one of the first use cases we had of mobile consumer traffic, where we're actually tracking people through their phones, where they're going and how often they're walking inside a Victoria's Secret store. And finally, we were also taking a look at the number of tweets and the social sentiment around those tweets. We saw that Victoria's Secret wasn't being mentioned as much this December as in the past. So we dug in a little bit. We found out that the biggest driver of the month is their annual fashion show that happens in early December. And we took a look at the ratings, television ratings for that fashion show, and they were really poor. So that got us interested. And then we started doing some of the more manual work we do on the margin side. Because I read what Victoria's Secret said about discounting less, and instead what I saw is, oh my God, the number of SKUs that they have on sale on their website was actually accelerating versus what was going on in November on a year-over-year basis. And at the same time, the depth of the discount they were offering was also much higher across their most important categories. And the number of promotional emails and tweets and sort of promotions on their website was just blowing up. And that seemed to start happening about a week after their top line trends all decelerated. That started telling me, I'm not super smart about retail, but I know enough to know that if your sales miss your expectations and you're a retailer, you got to clear through that inventory. So you got to discount. And the timing of when sales seemed to drop off and traffic seemed to drop off, and when they started discounting, more really aligned. But ultimately, that alone would have been enough, I think, for me to act on it. But making it as big as we did required figuring out why this was happening. And so what we did is we just read all the tweets that were tweeted out around the Victoria's Secret fashion show. There's a hashtag Victoria's Secret fashion show that people use when they're talking about it online. And we've read at least a couple thousand tweets, a bunch of blogs, Instagram posts, and it became apparent that Victoria's Secret was misaligned with a very important consumer trend. Women were moving away from the big push-up bra, Victoria's Secret Angels kind of look. They are finding it fake. Once again, correct me if I'm wrong about this, but like I've got a mountain of research that'll back me up. And so they sort of missed the bralette trend, and it kind of makes sense why bralettes are lower price point than traditional bras. So they didn't want to hurt their comps by really leaning into that trend, and I think they were hoping that that trend would disappear. Instead, it massively accelerated during the worst possible time for them. And so we basically were able to figure out that not only are sales going to be bad and margins are going to be bad, but it's not a one-time blip. It's not like when the Gap's warehouse burned down and they were going to have like a one-quarter miss. Who cares about that? This was going to be kind of an assault, at least for the next few months, few quarters, heck, maybe longer, on the most important asset that Victoria's Secret has, which is its brand and its brand relevance. So that gave us a lot of confidence to, and especially since the stock hadn't moved that much from November to December, that gave us a lot of confidence to make it a big short, and it turned out to have worked out very well for us. That's basically the approach that we take to investing, which is relatively unique, but we think that some of the things we do could be useful to lots of different types of investors. So with that in mind, the last thing I will tell you is kind of what we do at Chimera is a little bit different, a little bit niche and quirky, but I do actually believe that alternative data can be useful to lots of different types of investors. And probably the biggest category of investors is your traditional long-term value investor. And it's a model I still very much believe in, despite the fact that it's become difficult to do in consumer and retail. But a lot of long-term investors I've spoken to kind of look down on the idea of tracking short-term data. They kind of snub their nose and say, we don't care what happens tomorrow. We're in this for the next 5 years. And a part of me is saying, great, don't ever look at this stuff. But a part of me is saying, you could be smarter than this. You're being a little bit myopic, in my opinion. And that's because I think there's two things that alternative data can help long-term investors with. One is, at the end of the day, if you're in consumer retail, you want deep consumer insight, right? And there is no better data set available than some of the things that are on the list that I showed you for figuring out actual consumer preference and actual consumer trends. If you're a long-term investor in Wayfair, there's basically one thing you need to figure out, which is whether all the money they're spending to acquire customers is actually a positive NPV, right? They're spending all this money to acquire customers, but they're not profitable. You got to figure out whether the lifetime value of that customer is actually positive or not. That's the biggest controversy in that stock. So if you're a long-term value investor, don't you want to actually track the customers by cohort and figure out whether each cohort is becoming more and more loyal and retention is actually going up like the company claims or not? Right now, the answer actually kind of seems to be yes, but you wouldn't know that if you weren't tracking some of this data. Or let's say you're a long-term investor in Ulta, the cosmetics company. Don't you want to know who you're taking that share from, all the share that they've been taking? And don't you want to know what some of the competitive threats out there might be? Target right now is testing blowing out their cosmetics department with much lower prices and a lot more selection, and they're testing it in a relatively small but significant number of stores. Don't you want to know what impact that's having on Ulta stores nearby? Because what if Target succeeds with this initiative and blows it out nationwide? You can't get that kind of granularity without using alternative data. So I think there's opportunities for long-term investors to make their process better, their long-term theses better by tracking this data. And then finally, do you really enjoy blowing up on quarters? I hope people keep doing it because it gives me an opportunity to have a business. But at the same time, I think people should realize that in a space that's so hard to predict, short-term things matter now, and why take the pain? And I'll give you an example that just happened just a couple of weeks ago. A really good friend of mine from HBS called me right before Best Buy reported, and she asked me like, "Hey, how's the quarter looking?" And I said, actually, to be honest with you, and I said it kind of sheepishly because I knew that she had developed a long-term structural short thesis and that her fund was significantly short the stock. And I said, listen, I'm sorry, but like, I think it's looking really good, and I think they'll say lots of good stuff, and they'll beat, and I'm long the stock. And she just said, oh crap, except she didn't say oh crap. And then I said, well, why? Like I'm happy to show you what I'm seeing, and you guys could act on that. And she said, no, I can't act on that because it's career risk for me, right? Let's say there's a 90% chance you're right, 10% chance you're wrong. If you're right and the stock's up a lot tomorrow, I go to my PM and I'll say, hey, look, this is a short-term thing. I still think that the company's going to go down over the next few years. Let's short more, right? But let's say you're wrong, and I go to my PM after cajoling him to short the stock for the last 6 months and doing all this work, and I tell him, hey, still a great short long-term, but we should cover some right now to avoid the quarter, and you're wrong. I might get fired tomorrow, right? And I think she's right about that. I think that's how a lot of portfolio managers think. And I think there's an opportunity for the value investment world to maybe inch towards taking more care to figure out what's going on in the short term. Because you might be right in the long run, but something might happen tomorrow that's going to make it seem like you're wrong. And why would you just ignore that? Anyway, quants, space I don't know nearly as much about. But one thing quants have told me is that alternative data frequently doesn't have enough history. Because they like to have 10, 20 years of history of backtestable data, and that sometimes alternative data doesn't cover quite enough names. And I would say, on the one hand, it's certainly true, but that's changing, right? Because there's more and more history of these things happening all the time, and as the industry matures, there'll be more history, and that'll take care of itself. But also, I think the amount of signal in alternative data is much greater than the amount of signal that's available in traditional market data that quants use. So I'm not a quant, but I believe there's got to be opportunity there for people to make their existing models better and maybe even start new models. And then finally, macro investors. Once again, a space I don't know a ton about, but I know enough about it to know that they care about what's happening with GDP. Consumers, 70% of the GDP, and there's, as far as I know, no better, more granular, more real-time view on how the consumer is actually doing than various types of alternative data. So I think this is the wave of the future. I believe over the next few years it's going to become table stakes, basically sort of across the investing universe. And people that don't pay attention will be left behind. That's all I've got for you from a presentation perspective. I don't know how much time I took, but if there's time left, I'd be happy to take any questions you've got.
Thanks for sharing your insights and experience. Just curious on your investment process. Is it fully quantitative, or is it like fully fundamental, or is it a hybrid?
Well, our name should tell you. The reason is because it's on purpose. Chimera is a hybrid. Our investment process is fully a hybrid. We don't touch any stocks or you spend any time looking at any stocks on which we don't feel like we have a palpable data advantage in being able to track them. Our investment process starts with tracking the data and identifying inflections and dislocations from expectations, but the rest of our investment process is entirely discretionary. We use the data to spot inflections, spot interesting situations like we did with limited brands, but then we try to dig in and figure out whether anyone's going to care about the reasons behind what's happening. And so it's really very much a hybrid of the two.
If you were to provide a percentage, what percentage will come from the black box? What percentage will come from the discretionary?
Well, in a sense, it's like 100% to both, because all of our ideas originate with the quant side, all of them. And all of the companies in our investable universe are exclusively only companies that we feel like we have an advantage tracking. But also 0% of them are actually 0% of the trades that we make are actually based solely on what the data is showing. So it's very much hand in hand, 100% both. Anyone else?
How do you reconcile instances where in high volume names the data gets priced in prior to the earnings announcement? Do you have to time your position differently for those types of names than you would for names that are less followed or lower volume?
It's really hard to say because so many different factors impact what a stock does when it announces earnings, and frequently it's factors that are entirely unrelated to whatever numbers we're tracking or whatever thesis that we have. It certainly happens quite frequently that we get the numbers right, and the company ends up saying almost exactly what we thought they would say on the metrics we're tracking, but then for some other reason, the investment or the trade goes against us. We haven't I don't think we've done enough work to try to figure out whether high volume names, the stuff gets priced in faster or slower. But I will tell you this. We invest in small caps, mid caps, and large caps. And what we have done is we've taken a look at our trading over the last couple of years. And we take a look at our hit rate and then our average gain, average loss. And there is no statistical difference between our winners and losers between large caps and smaller caps, despite the fact that we trade them basically the same way. And I think honestly triangulation has a lot to do with that, because I'm not pitching you guys as investors, but for us, I think the reason for that is we triangulate across a lot more stuff than other people do. Anyone else?
Question, with the kind of that black box format of investing, would you say, just in general, that it sounds like that has gone down? Is that the case, or is it going up?
Honestly, I'm not in a position to answer that question because I don't know what's going on at AQR and RedTech and Two Sigma. My impression is that those funds continue to do well. I don't know whether it's going up or going down. I don't have enough of a view of the entire market, I think, to be helpful in answering that question.
Thank you.
I have a question going back to the social media data point from earlier. I'm curious how you go about weighing that part of the information. Using your example from before, in the Victoria's Secret example, you mentioned you were sifting through tweets, Instagram posts, things like that. Is part of the process too thinking about what percentage of the Victoria's Secret market is engaging with different social media platforms? How representative are those tweets of the full customer base?
Absolutely. We have to think about what you just brought up, like how representative is what we're seeing, how important is it to the average consumer. That's absolutely an important thing for us to take into consideration. For Victoria's Secret specifically, their core customer is a young woman that's highly engaged online socially. So we believe that very much representative, especially since the volume of tweets was very, very high. The question you asked about how we weight it, that's when we get into the realm of marrying the art with the science, because we don't have an algorithm for weighting this sort of thing. Heck, maybe in the future we will, but right now we spot an interesting dislocation, and then we do more of this bottoms-up work where I have to know what matters to the story of various stocks that I'm following, what matters to the constituency that's buying it, what matters to the constituency that's shorting it, and make a discretionary determination, myself personally, whether it's going to matter or not. And there's no weighting to that.
What degree of adoption or resistance would you say that you think the companies... Sorry, what degree of adoption or resistance would you say the companies that you're speaking to on a daily basis, that you're investing in or seeking to potentially invest in, are either fighting or embracing the data world that's now sort of prevalent in the last 4 to 5 years?
Great question, but I'm afraid my answer will be unsatisfying because we made a philosophical choice to stop speaking with humans. I used to do GLG calls and talk to management teams all the time. And again, maybe I wasn't smart enough or good enough to gain useful information from that, but I found that managers of companies have gotten really good at hiding the ball. And that's good because there's Reg FD now, and really they shouldn't be telling me stuff that's material non-public. And so I found it relatively inefficient to talk to management teams to figure stuff out, because that it's expensive, and it covers one company, one snapshot in time, and then the opinion of one person. I like to look at data now, which covers lots of different companies in a systematic way, in a way that's actually a lot cheaper per name than talking to people. I will tell you that I don't have any reason to believe that companies are actively resisting this, because I'm not sure they have. I'm not sure that they need to. I mean, whatever information I'm tracking is stuff they're going to have to come clean about, a few months or a few weeks down the line anyway. So I don't see how much advantage there is for them. What I would care about if I was a brand or a company is making sure that my competitors aren't able to gain competitive information based on what I'm doing. And companies are doing some stuff. They are trying to, for example, battle web scraping. And sometimes legally or sometimes based on the way that their websites are structured. I mean, there's there's companies out there like KMX or Zillow, which have been being scraped now for years, where like, hey, you want to know how many cars KMX sold? Well, their website will literally tell you to almost the exact number. And they've been trying to fight that because they have competitors, right? So they don't want to know, they don't want their competitors knowing how many cars they're selling and at what price. But other than that, I'm not aware of companies taking significant steps to combat, I guess, the way we're tracking them, in part because it would be really hard, and in part because I'm not sure that there's that much of a reason to do it.
Why don't we take one more question?
Okay. Great, thanks. So as more investors start using this alternative data, do you think the opportunity set has decreased and the risk reward, I'm just thinking about some of the big blow-ups that have happened with some shorts, has that changed over time?
Well, maybe. For me, it's only gotten better, right? Because we're at a very low level of adoption of this kind of data. People always think like, oh, credit card data, like it's mined out. Well, not if you use it right. Like if you triangulate across a bunch of stuff, you don't blow up on things like tailored brands, which is called out as strong, as weak, and then ended up being much stronger. Because you're triangulating across other stuff, and then if you, sorry to tell you this, but sometimes if I know 1010 is going one way and like all my other stuff's going the other way, those are some of my best trades. So we haven't noticed any kind of alpha decay, which isn't to say it won't happen, but at the same time, if you take a look at the big picture, connectivity is only growing. Trackability is only growing, and it's growing exponentially. Like my view on it is that the amount of big data that's already been studied and acquired by the market is actually very low. My list of sources that I'm not even using yet, because I haven't had time to review them, is multiple times bigger than my list of sources that I actually am using. And I think it's growing faster than I have the capacity to even get my hands around. So I think this is a, multi-decade process that we're just in the beginning stages of. Okay, thank you, everybody.